Good afternoon, folks. It's David Burrows, President and Chief Investment Strategist at Barometer Capital Management, and I want to welcome you all to our Tuesday weekly webcast. It's a webcast where we generally spend our time going through what's been going on market-wise, what may be changing in our view of the world, how we're positioned in current markets, and most importantly, we talk about market leadership. You know, at the end of the day, I think when a client hires a portfolio manager, what they really want is for the manager to have tools to try to identify where the leadership is in the market, the important areas of the market that are going through structural change that could lead to multiple revision or expansion in prices. And I think that realistically, we don't have to be everywhere. We've got to be able to target the most important areas and perhaps avoid some big parts of the market. And by doing that, take advantage of the big structural themes. So there's a lot going on. There's been a lot of discussion around Fed policy and interest rate hikes, lots of discussion around inflation. We spent a lot of time over the last year talking about reflation of asset prices. We've got lots going on still with COVID, as it seems we are approaching what may be the peak of this wave with Omicron, and who knows what comes next. And markets are trying to do their best to look through all of these pieces of news and all of this noise and figure out what's going to happen in the economy, which sectors are going to benefit, which sectors are going to be hurt, which areas to focus in, which areas to avoid. So what I'd like to do is, as always, start from the top. Now, we make our decisions based on process. Our work is aimed at identifying areas of the market that are seeing net inflows of capital where breadth is expanding. That tends to be healthy. We try to identify weakness early by recognizing narrowing breadth, where the percentage of securities within that neighborhood performing well is contracting, so that we can reduce our weights. We use stop losses on all of our positions, so that no matter how right we think we are, if something isn't working out the way that we thought it should, we'll get stopped out fairly quickly and make sure little mistakes don't turn into big mistakes. So of course, we invest across asset classes. And so as always, I would just want to start by taking a quick run through from a high level. We think that we are in a structural bull market in equities that started in 2013. And there have been several steps forward and a few steps back along the way. But we've now been 9 years since the S&P made its last new high. And secular bull markets can be as much as 20 years in length, 16 years in length. They can go on a long time. And very often when we're making new highs in markets, it's a little scary. But the fact is, in a secular bull market, you make lots of new highs. And so to try and pick tops is a really dangerous game. Our view is in the near term, we have a tailwind in equities in the US and really around the world. We're going to talk a little bit about that. In rates, we've talked about the fact that we think we've been going through a generational bottoming in interest rates, and that we're headed into a reflationary and a slightly more inflationary environment where rates go higher, much like they did through the 1950s and 60s. And I thought I'd maybe just take a moment and talk a little bit about that, because when we look at interest rate cycles as we've gone along here, there have been some very long cycles in the past. And as I always say, what works in rising rates is not the same as what works in falling rates. But we know that coming out of the Second World War, interest rates on the 10-year bond hit a low of about 1.7%. Interest rates were held artificially low to help manage the war. And as we came out, slowly rates started to work their way higher. And then they worked their way higher all the way until 1981, where you got 15.8% 10-year bond yields. And Fed Chair Volcker hiked rates dramatically to try and choke off inflation, and ultimately he was successful. One of the big questions is just how much inflation was there early days? And it's interesting, if we look at it, this is year over year inflation. And we know that after the Second World War, there was 2 years of higher inflation, about 6% inflation, as there were supply bottlenecks and lots of demand. But then inflation waned. And actually, while rates went higher all the way through the 50s and 60s, inflation really was stuck sort of in the 1 to 3% range until the late 1960s when it started to ramp higher. But that was like 10 years of relatively low inflation after a spike in inflation that came after the war. And I think that that's kind of important because we are seeing a big pickup in demand for things. It may be that this is a lot like a war. It may well be that some of the inflation is transitory. I think there's concern that it may not be, and we don't know the answer to that. But when we look at what happened to short-term interest rates out of that period, we know that Fed funds rates cycled through business cycles. The first business cycle, Fed funds rate went to sort of 3.6%, then they pulled back close to zero again. Then they moved higher in the next business cycle to 4%, then they pulled back to just below 2% in the late 1950s, and then worked their way higher, into the middle 60s at 5% and 6%. So when we talk about rates going higher, we don't expect rates to be rocketing higher into the teens. We think that interest rate cycles take a while to turn. They come in fits and starts. We had a big run higher in yields from 50 basis points in March of 2020 to just about 2%. Then they pulled back to just above 1%, and now they're moving higher again. So when we look at the 10-year bond yield today at 1.8%, okay, this is higher than it has been in this interest rate cycle. It does support the idea that from April until this fall, rates which had initially moved higher stalled out and consolidated, but that we have begun a longer term rate rising cycle, which means it's probably a bear market for bonds. And it's not just in the US. German 10-year bond yields this week made their cycle high, now trading just about flat. So they've had negative bond yields going back over the last few years, couple of years. And the number of negative yielding bonds, which was enormous a year ago, is shrunk dramatically. But we're seeing yields go higher on bonds around the world. This is the aggregate bond index in the US, and bond prices very clearly are falling. It was a negative year for bond returns last year. I think most people know we've been quite negative on the bond market, thinking that you're not getting compensated well in the interest you're getting paid for the risk that you're taking against inflation. And it looks like it continues. On the commodity front, we talked about the fact that we got to probably the worst point in a bear market in commodities in 2020. Commodity prices have been falling in general since 2008. The 10-year return on commodity index was about -9%. We're back to a positive return. And if we look at it, commodity prices are going higher. This is the Rogers Commodity Index. It's an equally weighted basket of 27 different commodities. And as we speak today, we're basically making new cycle highs in commodity prices. So they are working their way higher. So fixed income, probably in a bear market. Equities in general continue to be in a bull market. Commodity prices look like they have made a cycle turn. This was the fall in commodity prices, right? This commodity index fell about 77% from top to bottom, is working its way higher again, but probably has a long way to go as we're probably an early cycle new bull market commodity prices. Let's talk about stocks for a minute. This is the S&P 500. In the past week, it did pull back about 4.8% off the highs. Now that was an impact of some of the inputs in the index, and largely it had to do with large cap technology. So this is the Nasdaq 100. You can see that the Nasdaq 100 hasn't made a new high since the middle of November. It made a couple of runs at highs. It's actually pulled back as of yesterday, just about 10% off the highs, which is not insignificant, held above the longer term 150-day moving average and rallied off it yesterday and rallied a little bit more today. We'll have to see. I'm not sure that this is completely done. When we look internally, there are some things that cause us some concern. We've highlighted for some number of months the percent of stocks trading above the 200-day moving average in the NASDAQ has been falling. So the average stock has had a much more difficult time than the index because, of course, the index was held up by the largest of large cap companies like Apple and Google and Microsoft. I can tell you that as of this morning, only 34% of all the companies in the Nasdaq 100, in the Nasdaq as a whole, are trading above their 200-day moving average. So that's significant. 65% of stocks trading below their 200-day moving average. That is a headwind. It means that lots and lots and lots of stocks have broken down. That started in the second month, February of 2021, and we saw that the percent of stocks trading above the 200-day moving average really has been falling since then as the Nasdaq deteriorated. This is probably why when you look at our portfolios, we have a significant below market weight in technology. So it's something important to kind of keep in mind. Now, this is the equally weighted S&P 500. Take out the impact of large cap tech, just give every one of the 500 the same vote. You can see that, yes, it pulled back a little bit this week too, 3.7%, but a long way from what we saw in the S&P as a whole and certainly in the Nasdaq. So that's good news. It means the average company is holding in much better in the S&P, and many of the S&P companies are sort of older economy companies, lots of financials and so on, but the equally weighted S&P hanging in quite well. So whereas the Qs haven't made a new high since November the 22nd, equally weighted S&P made a new high just 3 days ago, and in fact today had a very nice rally. A far cry from sort of unprofitable tech. And we know that companies that are trading at 10 times their revenue with no earnings have had a very difficult time. Kathy Wood's ARKK ETF we highlighted last week in some difficulty, more difficulty this week, down at the low point yesterday, 80% off the highs from February. And of course, that includes a lot of the meme stocks that we heard about late last winter. So just to sort of reiterate, S&P 500 has been making higher lows. The equally weighted S&P 500 doing better. Nasdaq 100 a little bit worse. Russell 2000 has been treading water. So this is important because we got to focus on being in companies and parts of the market that people care about. And the big question is, has the weakness in tech, is it washing over into the rest of the market? Should we be concerned? So on our big indicators this week, percent of stocks in the NYSE that are in uptrends did not move lower. It moved lower by about 1%. That means breadth continues to be healthy for NYSE companies. Global equities breadth, again, was actually a little higher this week. And in Canada, the index was fine. There was no movement in breadth. I'd like to see breadth move a little bit higher in the Canadian market, but actually the Canadian index relative to the S&P is showing relative outperformance over the last few weeks. When we take a look around the world at the breadth models that we look at, the percentage of stocks in uptrends in the US is positive and improving. Percent of stocks for all of Asia in uptrends is improving. Percent of stocks for all of Europe is improving. Percent of stocks in uptrends in the Middle East is improving. Percent of stocks in uptrends in China is improving. Percent of stocks in uptrends in Japan is improving. Some notable weakness in Latin America. But breadth generally around the world looks to continue to be quite constructive. Let's look at volatility. Volatility over the course of the week peaked up a little bit yesterday morning, but again, staying below recent highs. So no major concern there. Volatility continues to be contained. So let's talk about leadership. As you know, we're not trying to be everywhere. We're trying to focus in areas of strength, trying to identify those groups, sectors, themes, geographic regions, market caps that are seeing net new inflows of capital. We always are watching for change in that leadership. So we're going to talk about that now. And in the event that we see deterioration in leadership, we're very prepared to play defense. We're very prepared to reduce our weights. We're very prepared to sit on cash if that were needed. So clearly in tech, the heavy, very high multiple revenue companies are having a difficult time. And we'll see how that plays out. But I think that there is some reason to have concern for high multiple growth stocks in the near term, with interest rates going higher and inflation posing a little bit of a problem. If we look at the various groups within tech, software we've talked about has been having difficulty. The IGV ETF, which is made up of large cap software stocks, is down 21% off the highs, bounced a little bit yesterday and today, but certainly now trading below all the long-term moving averages. The cloud ETF, SKYY, is trading 21% off the highs as of yesterday morning, bounced a little bit today, but again, trading below long-term moving averages. Not to say it can't get back up and above, but now it's got something to prove, probably not an area that we would be adding new money. Cybersecurity trading 15% off the highs is CIBR ETF, obviously continuing to have difficulty. One of the last groups to roll over. But when we look at the XLK, which is made up of and dominated by the very largest of profitable tech companies, a little bit better, down 8% off the highs, but again, still a lot worse than the equally weighted S&P 500. Some of our notable holdings have held in quite well. Apple now sitting just below the highs, trading better than 93% of companies in the S&P. Had a little bit of a pullback over the course of the week, trading above the 50 and 150-day moving average. All okay there. Cisco trading just below the highs, one of our large cap tech holdings, actually making a new relative high versus the S&P today. So that's hanging in well. Again, highly profitable cash flow generating company. And while Microsoft has certainly pulled back, it's sitting above the 150-day moving average. I will say we trimmed some Microsoft this week for accounts. One area that I am a little bit more concerned about is semiconductors. They've been a driver of returns over the last 2 years. This is the XSD, which is an unweighted index, meaning all of the semiconductor weightings are about the same, a little over 3% across the board. NVIDIA, which is a large holding of ours, continues to be a large holding, but it's pulled back into an area that we would like to see support. You can see it gapped higher late in October. We've come back and filled that gap. We'll see whether we can hold these levels. Long-term moving averages are moving higher nicely. If I were to have to choose one today, though, probably I would choose Broadcom, which we've talked about over the last few weeks. Broadcom continues to outperform the group and it looks very attractive. So semis we're going to watch closely as the Nasdaq tries to bounce, because it's going to be important to see them hold and rally here. But I will say we have continued to take our tech weight down. So the question is, what does it mean sort of for the rest of the market? Well, let's talk about the other leadership groups we've been focused on. This is the XLF, which is a broad-based measure of the financials sector within the S&P. Well, we made a new all-time high today. So that's really favorable. Now that includes banks, it includes insurance companies, it includes capital markets. It also includes digital payments, which the digital payments ETF is down 25% off the highs. That tends to be higher multiple, higher growth companies. But it also includes the banks. So this is the bank ETF making a new high, going all the way back to 2008. We talked last week about the fact that it had broken out early in the year, pulled back, and was now rallying off it. So we believe we've started the next big leg for the financials. We're in a new bull market for banks in general. Whether we're looking at U.S. banks, and this is the daily chart for the KBE. You can see here we were just about a half hour ago trading right in and around the highs. This is the Canadian bank index. It's an index of the an unweighted index of the Canadian banks, meaning each bank is worth the same within the index, making a new all-time high today. So certainly no major negatives washing over into the financials, and certainly in our leading holdings in the portfolio, we've had a great week with companies like Royal Bank, Bank of Nova Scotia making new highs, Bank of America is making a new all-time high, and Morgan Stanley pushing right back toward highs. And if we can get out of this consolidation, I think the investment banks have another big run. Goldman Sachs would probably be in that same camp. Now, last week we talked about energy, and how energy has been outperforming software on a relative basis, maybe new leadership versus old leadership, more economically sensitive versus more predictable. We talked last week about the fact that in 2021, number of barrels found was the lowest number of barrels since 1946 globally, and oil prices are working their way higher. So again, what I would say is we are not seeing money leave the stock market. We are seeing money move from one pocket to another. So we've seen money come from some areas of growth, companies that tended to do well when we were concerned about the rest of the economy not doing well because tech is more predictable and less economically sensitive, and see it move into some very economically sensitive parts of the market where inflation becomes your friend. So of course, as oil prices work their way higher, so too do energy producers. This is the XEG index. Again, we talked about it last week, making a new high today, and certainly a new relative high versus the S&P. This is the Canadian producers. CNQ would be probably our biggest holding of energy. And Canadian Natural Resources has like 100 years of reserve life and very low cost production. But the strength is not just in companies like CNQ, some of the smaller mid-cap names, Tamarack Valley, which we talked about a month ago, making new highs here, as are virtually all of our energy holdings. The XOP index, though, in the US, which is the Oil and Gas Exploration and Production Index, you can see is making its way back. The index fell 90% from 2014 through 2020. You got a long way to go. Excuse me. I will admit I am quarantining in my home with COVID. So, number of constituents in the S&P 500 energy sector has been falling steadily since 2013. You can see it represents at this point a pretty small part of the S&P, which is why it's only about 4% of the S&P. That's a positive for us. There are fewer companies in the index. There are fewer people who have been invested in energy. And oil is in limited supply. As we reopen the economy, we think this is an area that risk reward favors us. Let's move on. Industrials, which have consolidated over the last few months, a little bit frustrating for the index itself. Our holdings, I think, are behaving pretty well. I talked about General Dynamics last week, trading virtually near the highs. Textron also near the highs. Another one of our favorites here in Canada is Ats Automation. ATS and as it sounds, automation business, providing designing, building, and commissioning automated manufacturing systems. And we know that companies are trying to invest to become more productive in their production methods, and ATS is certainly benefiting. So industrials seem to be okay. One company that we have had that's been a little bit frustrating recently is CNR. Has certainly pulled back. It gapped lower when their new CEO he would not be with the company. But having said that, our work said this was probably not a major issue. Excuse me. And that likely stock would find a footing. It's done that above the 150-day and 200 moving average. If we were to break there, I think you would expect to see to go to the sidelines. Commodities. I've talked a lot about these over the last few weeks. Commodities on their own or relative to equities, in both cases, looking quite attractive at this point. We think that they've made a pretty significant turn. We've seen the RJI index make a new high. So we certainly consolidated over the last couple of months in various commodities, but they have turned and have started to reaccelerate. Now we've been making a point recently with clients that we had a tremendous lift from November of 2020 through April, May of this year and the first big reflationary push. And then from May until November, tech again took hold, and the reflationary trade took a back seat for a while and took a breather. In people time, 6 months is a long time. In market time, it's a pinch of time. If you think you've entered a new structural bull market in an asset class, you're going to see it take breathers. And so, of course, it's then important to see the theme reemerge. We know that materials, while it had a rest, saw a lot of money flow out of the group. But here we are now making new highs, and the flows are only just starting to come back. That means that appetite has been regenerated and money can continue to flow into this group. So if we take the base metals as a group, this would include nickel, aluminum, copper, iron ore. After a rest, they look to be reaccelerating. Now that's important. Now overnight in China, they talked about the fact that they plan to increase their spending on infrastructure. And we know the supply is tight around the world. Let's look at some of our groups. Alcoa making a new relative high today. This would be our largest base metals company that we hold. We talked a lot about Freeport-McMoRan, which continues to perform well. And of course, Teck Resources really moving over the course of the week to take out highs. So again, market action would tell us that money is repositioning into economically sensitive companies, companies that have an ability to raise price, companies that have an ability to benefit in an inflationary environment. These companies are underowned and unloved. They are have a very strong pricing power, and we think these are the kind of companies we need to own in this environment. Let's move on. This is the long-term picture for the XME, which is the metals ETF. Again, we broke out early last year, consolidated, now starting a new leg higher. First, Quantum would be another company that would be a favor of ours from a copper perspective. Broke out, pulled back, starting a new leg higher. Forestry. Forest products look great. Interfor, Canfor, Louisiana Pacific in the US, again, continue to work their way higher. And then finally, just on the basic materials on gold. Gold's been a very frustrating trade for a lot of people. This is a long-term chart. This consolidation goes back to 2011. We broke out early last year and then consolidated for basically a year. I would say we're getting to a very important price point here. If gold is able to move out of this range over the next few weeks, my guess is there's a pretty good move higher. And frankly, the stocks have started to outperform the metal, which is always a positive. So we'll keep an eye on that as it relates to the portfolios. Consumer discretionary was a little choppy this week. It certainly pulled back with the market. One of the things I think you have to keep in mind is in the consumer discretionary sector, Amazon is a very big part. Amazon is not a holding for us currently. It hasn't been for quite some time. It really is underperforming relative to the S&P. Excuse me. And so this is one I think that I'd be a little bit careful of. On the other hand, the auto stocks acting well. There's Ford, the home improvement companies, that's Lowe's, acting well. But frankly, within the consumer, we're also seeing strength in the consumer staples, and we're spending time thinking about that. We do have exposure to a number of consumer staples companies. We spent part of last year thinking that staples were less likely to perform well in an inflationary environment. It appears that they're able to pass price along, and we've seen consumer discretionary relative to the S&P 500 weaken, while we've seen consumer staples relative to the S&P improve. So you'll see in our holdings, we've been increasing our weight in consumer staples. So let's talk yields just for a moment. Yields are clearly moving higher. There's the 2-year Treasury yield. Important to note, we're now above where we were, the pre-COVID low. The The 7 to 10-year bonds are at risk of taking out, have taken out the recent lows. So they clearly are not an attractive place. So where does an income investor go? And that's a big question, because a lot of our investors have investments that are focused on generating cash flow. They know that we are not in the bond market other than where we have to be. In our balance mandate, we have our minimum bond weight in short-term bonds. Our income mandate has been made up of dividend growth. Our view is that dividends will be a very important part of portfolios going forward. Historically, they've been 60% of returns for investors since 1930. Dividend growth is very attractive when rates are going higher. We want a rising stream of income. This is the RDVY, an ETF that invests in companies that historically have been able to raise their dividends. This is the Morningstar Dividend Leaders ETF, making new highs today. Very attractive. Other areas we can focus, excuse me, technology companies that have had a history of raising their dividends. This is an ETF with a 1.8% dividend yield. It's grown its dividend 10% a year. You can see has not pulled back anywhere near what the Nasdaq 100's pulled back. And then there are the resource dividend growers. GUNR is a dividend growth ETF that's focused in upstream, large-sized commodity producing companies. So the differential between growth and value is being squeezed. It's got a long way to go. The world has been focused in growth and growth stocks for several years, and they tend to do well during falling interest rates. If in fact we are into rising rates, areas like financials and commodities likely have just begun their outperformance. And now we've been positioned here in that camp sort of for the last 18 months. And while we think they will have the odd rest, we think we are just starting a new leg higher. And you can see it in the value, VLUE ETF, which is made up of MSCI companies with a value factor. We know that in the Russell 1000 and Russell 2000, value is now outperforming growth. And so when we go to our holdings, how does that reflect? Well, financials continue to be our very largest weight. 25% of the portfolio, 2.5 times the market weight in the S&P. Tech continues to come down. It's now 13% of our total firm assets. Our income portfolio does have a tech dividend weight, which would be larger, but that's because there are some very good dividend growth companies that we just talked about. Materials is over a 4 times index weight. Energy is a 3 times index weight. Those would be our biggest overweights, along with financials. Consumer staples has become a larger weight in the portfolio just because it appears right now the consumer staples companies have been able to raise price as inflation has impacted their costs. And at the other end of the spectrum, healthcare, consumer communication services continue to be a very small part of our portfolio. Now, our most flexible mandate would be our macro portfolio. Macro is a long short portfolio. It only invests in ETFs, long or short. Big weights would be financials, commodities, industrials, materials. We do have some exposure to both Bitcoin and Ethereum, about 10%. Dividend paying companies, about a 6% weight in emerging markets, largely that's China, but also an India weight. Forestry, very small weight, about 5% technology. And on the short side, basically fixed income and short US dollars. So we think this is a structure that works well in the environment that we're in. It's a complement to our other portfolios that we run, and is aimed at having a very low correlation with the stock market. So as we look forward, we're into that seasonally strong period of the year. That's a positive. we know that there are tremendous flows that come into the market structurally in January, February, and March of each year. We know that the consensus for earnings in the S&P continues to work its way higher. These are all positives. We know that despite what happened to me this week, the positivity rates and the daily cases are flattening out in New York State at about 26 days, which was about what happened in South Africa. It means it's probably likely to happen here in Ontario very soon. So the market is trying to look past that stuff. The negative is that for tech, it may be that the underperformance could last longer. We know that there were tremendously aggressive flows into tech over the last 3 months, and it's only just started to come out. Now, there were significant flows out last week, and things certainly became oversold yesterday. It may be we bounce a bit. It may be that it's able to catch a bid and rally with the rest of the market. But I think we do have to be a little bit cautious there. When you look at the rallies that we've seen over the last couple of years, we had 90% of companies above the 200-day, 93% of companies above the 200-day moving average, 90% of companies above the 200-day, 80% of companies above the 200-day. As we sit today, 55% of companies are above their 200-day, and that's not been moving higher. So this is deteriorating breadth, and this is something that would give me some cause for concern, which means that it's just not a camp that we're spending a lot of time looking to put new money to work. Now, should our overall breadth models roll over, we will get defensive. We've shown that in the past. But as it is right now, it looks as though we're seeing more rotation than correction. And we're very optimistic about the themes that we have. We're conscious of the fact that we're headed into a Fed tightening cycle. It doesn't tend to be that it has a significant negative impact to markets until the second or third hike. So we think we're a ways away from there. It may be that we rally between here and April, but we will watch very closely for signs that this is working its way into the rest of the market. We've got inflation data this week that will be important to see how the market handles it. And we're going to get more Fed speak. So we'll keep monitoring. We'll continue to update. If there's something to talk about in between meetings, we'll certainly send something out. In the meantime, if there's some questions, maybe we can answer them. So let me see what we got. Okay, we've got a couple of open questions. Oh, there's more comments than anything. Yeah, well, you know, if you've got COVID, but you can keep on talking, you might as well keep on working. TFI International is taking a beating. Is it still a hold? It's one that we've had to stop our way out of. There have been some of the transports have had difficulty recently. I think there were concerns about, you know, what could transpire with another wave of COVID. As I mentioned, we're having to keep an eye on sea and rail. We'll see where things go from there. The next question is, do we believe that the correction is over? So as I just said on tech, I think it's possible that we are headed into a period where tech will underperform or will be challenged. I'm not saying it's going to fall a lot in price. It could. Certainly, there are some very expensive companies within technology. A lot of companies trading at 30 and 40 times earnings, where they were trading at 22, 23 before this last big rally. But I think it's not going to be where the leadership is. I truly think we have had sort of a watershed moment where we have moved from a disinflationary world to a reflationary world. For all of us, it's an opportunity. You know, it's easy to get caught up in talking about the companies that everybody wants to talk about. And there are some great companies. But I can tell you, for instance, Rio Tinto, which is the largest iron ore producers in the world, the last time it had the kind of consolidation it's just recently gone through, stock went up by 10 times in the next commodity bull market. So Rio Tinto's share price. So here is 10 years of trading in Rio Tinto from the time it broke down and began the last bear market. Made a low in 2016, made a higher low in 2020, broke out early last year, came back and retested the breakout, and has turned higher. So if we were to do a comparison to the last time the stock consolidated this way, you can see that when it broke out of the range, it broke out, pulled back, and when it turned higher, the stock traded, well, from 22 to 150. So 5 times, 10 times, 7 times, 700%. So I think this is where we sit with a lot of these companies. And I think that it's going to take a long time for investors to reposition for what is a different kind of environment. And there's going to be fits and starts. We have investors who have been patient waiting for it. I think that this all, frankly, was getting going before the pandemic hit and likely would have happened sooner. But frankly, given the fact that the Fed pushed so much more money into the system during the pandemic, the chances for reflation are that much greater today than they were had the pandemic not taken place. So these are themes that we're going to focus in. So long as they continue to behave the right way, we're going to try and take advantage of them. If things were to roll over or get more difficult, we'll sort of get defensive. But at this point, I think this is kind of what I would expect to continue to work. Just see if there's any more questions here. I think that's about it. Where we stopped out of any positions yesterday in the portfolio, I think we reduced a couple of positions, but our positions have been hanging in very well. I think we got stopped out at Thomson Reuters yesterday. I think that's the only one. So we'll see. Anyway, thanks everybody for joining today. I hope it was useful. I'm sorry for coughing at you, and look forward to shaking this little virus. And we'll be back next Tuesday. And if you've got any questions, please send them in beforehand. I'm happy to answer them during. If you're shy, you just like to talk to somebody, certainly don't hesitate to give me a call. I'm happy to take calls as needed, or send us an email. And everyone take care, and we'll look forward to seeing you again next week.